Hello, I'm Mr. Edgington, and today I will be teaching you a lesson in BAF 3M Financial Accounting Fundamentals, the College University Preparation course for grade 11. The unit, or strand, is financial analysis, and I'm going to explain to you the importance of current assets and current liabilities when interpreting a balance sheet. So I've drawn a balance sheet up on the board for you here. You can see very well. This business appears, before I tell you about the business, it's called Tom's Gardening. They garden, they do yard work for you. They're service business, which is what we're learning in this unit, in this strand, is service business financial statements. On March 31st, the end of last month, they were worth this whopping number here. $43,000. That looks good. It all looks fine and dandy, but it's not. If we look at our fundamental accounting equation for this business, assets equals liability plus owner's equity, we come up with 268,000 equals 225, which means our assets are greater than our liabilities. That seems great, but it's not. By $43,000. That is what this business is worth at this point in time. This balance sheet was a snapshot of this business at this point in time, and at first glance, it looks fine because we are worth $43,000. Mr. Tom Jones is worth $43,000, but we have to look into it in more detail. The topic of today is current assets versus current liabilities. We have current assets of $14,000. So current assets equals $14,000. That's money, or things that can be turned into money quite quickly. Readily available cash that we can use to buy new supplies, get more inventory, hire new employees right away, which is really nice to have for a business. Now our current liabilities, denoted by CL, add up to $25,000. Accounts payable of $5,000 and bank loan payable of $20,000. The current portion of that bank loan is $20,000 because we have that built in that land that we're just paying the bank back for. That's $25,000. So there's this thing we use in accounting called the working capital, and our working capital is equal to our current assets minus your current liabilities. Right? So current assets minus current liabilities. In this case, it's assets first, 14,000 minus 25,000. That means our working capital is negative $11,000. That means not only do we not have money, we will not have money for the foreseeable future because we're in the hole. We owe $11,000 more currently in these 30 to 60 days than we are going to receive in 30 to 60 days. That's not a good thing. Another way to look at it is the current ratio. The current ratio is current assets divided by current liabilities. So current ratio, which you want to be at least 1, is not. Current assets divided by current liabilities is 14 over 25, which we know is well less than 1. You want your current ratio to be greater than 1, maybe even 2. For a service business like this, you want to be having cash available for you to use in your operations, to hire new employees should you need to expand, to get new machinery and equipment if you need it right away. Machines break down, things happen in business, and cash is king. You want this cash, readily available cash, that we don't have really to run and operate our business. So you see the importance now of current assets, not just assets. Our assets more than cover our liabilities, $268,000 versus $225,000. But that's not good enough. Current assets are key. Cash is king. And if we can't convert enough of this, 14,000, to cash to cover our current liabilities, 25,000, then we're not very solvent as a business. We can't pay off our creditors. This bank, and maybe even the accounts payable people, are going to be wanting their money. And if we can't satisfy them, they're not going to do business with us anymore. We will default on our loans. We will lose our building. We will lose our land, all because we don't have the current assets available. You need money available to run a business properly. So our current ratio and our working capital tell us that we can't sufficiently operate our business. Even though we had a positive owner's equity and worth of Tom Jones, the owner, at this time we can't efficiently run our business, so things are going downhill. This taught to you by the value or the importance of current assets and current liabilities for a service business, for any business. Thank you for listening to my lecture today.